Sabharwal joins us now. I haven't interacted with him in a while, even though he's been on the channel. He was traveling, then I was traveling, then he was unwell, then I was unwell. So it's good to connect with him. So, sir, good morning. What are we talking? Infosys, what a howler, what a disaster.
Yeah, Nikunj. So I think the writing has been on the wall for IT outsourcing companies for a long time. However, I think people have wanted to ignore it because people just want to buy IT stocks at all points of time for some reason. Now, there is a time when we need to ignore a particular sector, focus on others, and this is that time. In fact, I would think that even this guidance is aggressive from Infosys side. I don't think they'll have any growth. In fact, we might have a degrowth scenario because project ramp downs are still on, and we might see further ramp downs in the current quarter, which is going on. See, relying on these technology company managements who change their guidance every quarter is not the right way to invest. That's what people need to realize. You need to do your own analysis. These managers generally tend to be quite bullish all the time. So I would still think that we are still some time away. Infosys at least gives a guidance so we get some clarity. Other companies just talk esoteric terms which you need to decipher yourself and which becomes tough. So I think the entire industry is going through a phase of transformation which will take some time.
Absolutely amazes me that how the commentary has changed in just 2 quarters. TCS used to be reasonably confident about a double digit growth and they would use words like all is well. But now, double digit growth is a tall task. Wipro delay in discretionary spend. Deal execution pushed to FY24. Double digit growth could be challenging. So Sandeep, now that the bad news is in the open, the question is that after today's fall, let's say Infosys cracks 5-10%, is it time to now buy the bad news?
See, normally, Nikunj, we would say that, but the problem specific to the tech stocks in India is that they are hugely overowned. Every retail investor wants to buy these stocks at every small fall. Infosys is the most owned stock among institutional investors. So, do these investors at some point of time take a call that this is not the sector or stock to be, and we should be somewhere else? So, I think that's what will determine where the bottom formation will happen. So, people have been trying to buy the bad news now for the last 2 quarters. Uh, Results come, stock falls, people think worse is over, they buy, pull up the stock, and then the results become worse. So so I would like to wait it out. Let's see, because see, we don't have unlimited money, right? So there's a set of money we have, which we need to invest in a set of stocks which we think can do well. Now, technology stocks at this point of time don't fall into that category. 6 months down the line, we don't know.
While we are talking about Infosys, the surprise actually, frankly, is L&T, a company which nobody expected could actually consider a buyback, considering that their business is in a natural uptrend and they would be needing capital as their capex cycle is growing. They are considering a buyback. And just for the benefit of our viewers, if a company is considering a buyback, that means they're confident of free cash flow. That means they want to reduce their equity and they want to reward shareholders. So what does this buyback from L&T mean, Sandeep?
Yeah, Nikunj, actually, it's quite surprising and came as a surprise to me also. Although L&T on the large cap side is our top holding, because of the fact that the stock is at a high and company announcing a buyback at that price is intriguing to say the least. So like you said, they would be very confident about their growth, their cash flow, and the need for capital, and that's why they'll be doing it. And I think there was there was some mention of a special dividend also. So I think the read through prior to the results seems to be quite positive from L&T. Let's say what comes out in terms of result and guidance, but overall, like you said, very surprising.
Yeah, that it is, and that's going to be one stock to really look out for, as would be many others, and so many earnings reactions coming in this morning. There's, of course, going to be Unilever as well, given that the volume growth at 3% is definitely quite below the street estimate, because the street was averaging around 5 to 6 odd percent. Sandeep, does it come in as a surprise as Unilever's volume growth is a miss?
Oh, sort of, but I think it's 1 or 2% here and there. It doesn't matter so much. But the stock is expensive, right? Because the company going at 5, 7, or even 10% trading at 55 P, tough to justify. So I think unless the volume growth picks up significantly, which some of these companies seem to be indicating that demand has picked up, like some consumer durable companies also, which I heard post results, they seem to be indicating that June seemed to be better after subdued April, May. So if that's the case and it picks up, then the stock could hold on. Otherwise, the stock's not really cheap.
Okay, I'm just looking at you, considering you track this one closely. What did you make of the performance? You know, while some of the brokerages are giving a mixed reaction, CLSA has downgraded the stock to a sell from the earlier underperform, cut their target prices as well. But Lloyd continues to remain a big drag.
Yeah, so overall results were mixed, but not something which gives a fillip to the stock price in the near term, obviously, because of the fact that across the board, sales momentum was not as good as what we could have expected. And the company did indicate some improvements going forward, but valuations are very high. So if you look at valuations of Havels, it trades at around 55 times earnings at a time when earning growth has been subdued, and they are actually pushing more on advertisement, promotion, etc., to push sales when consumer demand has been subdued. Good part for many of the consumer industries is that channel inventories are reasonably low or moderate, and to that extent, if there's a pickup in demand post monsoons, then these companies could benefit. So at this stage, there's no reason, I think, to buy the stock at this price.
Do you profit take here, given that there will be some foreseeable pressure on the stock?
Yeah, there could be pressure on the stock, but I don't see a big cut per se. So I think there could be some cuts, but so I would say that people who have been holding for a long time, the stock has done well for them. They don't need to sell for a 10, 12, whatever percent downside. But whoever is looking to buy afresh, I think they should wait it out.
Sandeep, there's also Aurobindo Pharma in the spotlight, and the company, as per Economic Times report, is eyeing a $5 billion revenue over the next 5 years. Any stocks that you track within the space, Aurobindo in particular as well, on the fundamentals?
Aurobindo, unfortunately, I cannot understand. But I think on pharma, we own Sun Pharma as a holding, which we are holding on, and I think the company is doing well. And Lupin is something where we have taken a contrarian bet of turnaround. It's done reasonably well over the near term, but stock still 50% off peak value. So if the turnaround sustains, that could do well. But then there are risks inherent in that also if uh, things don't pan out the way we think should turn out.
Some of the other names which are going to be reacting to their numbers, we already flagged off United Spirits. Look out for that stock. That's where you're going to see a big move perhaps. But IndiaMART as well. The EBITDA has jumped up almost about 20.5%. The board has also okayed a share buyback of about almost up to 500 crore rupees. So this is going to be another stock to look out for. IndiaMART is what I'm talking about. That stock will just come off you on your screens. Sandeep, this is one of the haloed stories of 2020, if I can recall. You know, when the fad was some of these internet companies and, you know, some of these platform companies, if you will. The story didn't quite play out as well in the preceding years. But what did you make of this earnings performance if you track IndiaMART at all?
Yeah, I've been tracking it. The performance is reasonable. We can't say that it's extraordinarily good because the reported earnings obviously include some other income and all. So if we look at core operating profit growth, it's around 20%. So stocks near not really cheap from that perspective. The different, so it's a very different company from other internet at sector companies because it's a cash generating company, unlike many others where there's no cash generation and cash generation could be some way off. So to that extent, it's a different company, but at these prices, it's not really cheap. The buyback announcement could provide some support to the stock, but otherwise, it's not really a cheap stock at these prices. As the growth rate, which was envisaged a few years back, that it will continue to grow at 30-40%, that has moderated significantly.
You know, apart from the companies that came out with their numbers, we'll be watching out for Reliance Industries, of course, today. Then there's Ultratech, JSW Steel, the likes of an Ashok Leyland, 197 DLF, etc., that will all be coming out with their quarterly numbers. And I was curious, Sandip, to get in your thoughts maybe on the cement pack, Ultratech Cement. We're expecting this time around that it could be revenue growth in the quarter. What is it that you're working with when it comes to earnings for the cement sector?
The cement sector is a very mixed picture because the companies have not been able to increase prices, and to that extent, it all comes down to cost management. So, whichever companies have seen volume growth and better cost management, they might actually do much better than others. So, like so for Dalmia Bharat, results were average, but Ultratech volume growth this quarter was quite strong, and they have been showing good cost control. So I think they could report reasonable numbers. The only risk for the cement sector is that supply increases are rapid, and to that extent, the companies are not getting pricing power despite volume growth. And once the input cost reductions play out completely, beyond that, to grow earnings, you need pricing power, and which looks unlikely for the near term. So I would think that it's a risk reward is balanced. I would not be a buyer in Ultratech at this stage unless and until something totally surprises completely positively.
I want to go back to PSU banks. I'm trying to say that the future winners would be from the PSU banking space. But in the near term, given the gap, momentum, and the sheer underperformance which PSU banks have had over the years, is there a tactical trade there?
Because this is very tough to call because of the fact that we are entering into a tough cycle for PSU banks now. So they have cleaned out the balance sheets. Balance sheets are very clean and all that. And once when interest rates were low, they could boost their NIMs, etc. Now we are entering into a phase where it's going to be deposit competition, and in my view, the large private sector banks are going to win there. So the margins are going to get squeezed now. But so if they're able to maintain their asset quality sustainably for some more time, then it's possible they'll still perform. But I'm skeptical on their ability to retain their market share in the bread and butter CASA deposits, and that is what will distinguish between banks.
You know, the one stock that you can't take your eyes off is Polycab. Sandeep, I don't know if you've been tracking the story or not. It's a recent listing. Since then, it's really been on a tear. The numbers were phenomenal. Investors, even if they, bought into IPO or even after that, are still have, doubled their investments from there. And it continues to move from strength to strength.
Yeah, Polycab, again, it's been one of the companies which has been very surprising in terms of the way they have done, because largely 90% is cable and wires, and even there they've been growing much more aggressively than any other player, and also showing margin improvements, etc. When the rest of the sector has not done as well. So some companies have, some haven't. So surprising. We had some holding in this stock at some stage, but we sold it off. So not holding right now, but I've been tracking the results and their calls, etc. So the company has been doing well.
Since we are discussing Polycab, the eyesore there actually has been Havells, and Sandeep, they're in the same business.
Just discussed Havells with you.
You've discussed, okay. Yeah. I was out. So sorry, I must have missed it. I'm going to, shift from there and talk about a stock which in a sense has been the real darling of the market and it is coming back. That's TTK Prestige, Kunal. It's above the 200 DMA.
I haven't tracked the stock, frankly, Nikush, for a while.
Okay. Sandeep, is there merit in buying consumer durables and consumer discretionary stocks now, given that the interest rate cycle is peaking out?
Durables, yes, but then in the near term, we've seen some rally, like we saw a rally in Havels and other stocks also. So I think in the run up to the festival season, we should. So what is the best strategy is tough to define. So we keep on accumulating slowly or try to time it more near over the next couple of months is something we need to see. But the story overall for consumer durables should definitely improve.
We'll let you go on that note. Good to have you on the show as always. The pre-open rates, not as much the Nifty, but I want to see what's actually dragging